Hey everyone, welcome back to the deep dive. Today we're going deep on interest rates.
Interest rates.
Yeah, you know those numbers that seem
Oh, yeah.
kind of boring, but actually they're like the secret sauce behind like every major financial decision you make.
Right.
Whether you're buying a house, saving for retirement, or even just like deciding where to put your emergency fund.
That's true.
So
It's
today
everywhere.
we're going to break down
Yeah.
how interest rates actually work,
Yeah.
what factors make them go up and down, and how they can impact your wallet both like positively and negatively.
Absolutely. And you know what's really interesting about interest rates is that they're kind of a double-edged sword.
Okay.
They can work for you or against you.
Oh.
It depends which side of the equation you're on.
Oh,
So
I like that.
yeah.
I like that.
Think about it this way. If you're borrowing money,
Okay.
the interest rate is basically the price you pay to use that money.
Uh-huh.
Like if you take out a loan to buy a car,
Yeah.
the interest rate is what the lender charges you for the privilege of borrowing that cash.
Right.
But on the flip side,
Okay.
if you're saving money, the interest rate is actually your reward.
Ooh,
It's what the bank pays you for letting them use your money.
gotcha. So it all comes down to who's lending and who's borrowing.
Exactly.
Okay. Yeah.
It's all about that relationship.
So I've heard about these different types of like simple interest and compound interest.
Yes.
Can you like break those down for me? What's the difference and why should I even care?
Yeah, that's a great question. So simple interest is pretty straightforward.
Yeah.
It's basically just calculated on the principal amount that you borrowed or deposited.
Mm-hmm.
So for example, if you lend someone $100 at a 5% annual interest rate,
Uh-huh.
they would owe you $5 in interest at the end of the year.
Okay.
Simple enough. Simple, right?
Yeah.
Compound interest, on the other hand, is a little bit more, it's more complex, but it's also a lot more exciting because it's like the secret sauce of growing your wealth.
Okay. I'm intrigued. Tell me more.
So with compound interest, you're essentially earning interest on your interest.
Wait, so my money is making more money just by like sitting there?
Exactly. It's like money making babies.
That sounds amazing.
Yeah, it is.
And a little too good to be true.
I know, right? But it's how it works. It's the magic of compounding. So
Okay.
let's say you put $1,000 into a savings account.
Okay.
That pays a 5% annual interest rate.
Uh-huh.
That compounds annually.
Yeah.
After the first year, you would earn $50 in interest.
Right.
But here's the cool part. In year two, you're not just earning interest on that original $1,000.
Okay.
You're also earning interest on that $50 you earned in the first year.
Whoa.
So it starts to snowball, and the effect just keeps rolling and rolling.
Oh, wow.
You're earning more and more interest each year.
So the more frequently the interest compounds, the faster my money grows.
Absolutely.
Yeah.
The frequency of compounding
That's crazy.
plays a huge role in how much you ultimately earn. So like an account that compounds monthly will actually outperform an account that compounds annually.
Okay.
It's at the same interest rate.
I mean, my mind is officially blown. Compound interest is like my secret weapon to like
It is. It's like a superpower.
financial growth.
It's like a superpower of
It's
financer.
just power of finance. Okay. I love it.
Yeah.
Compound interest is my new best friend.
It's awesome. But, you know, even with this powerful tool, there are still things to be mindful of.
Right.
Like high inflation, for example,
Yeah.
can actually eat away at your returns,
Right.
even with the benefits of compounding. So,
It's not just like a set it and forget it kind of thing.
no, definitely not. You have to pay attention.
Oh, okay.
And interest rates themselves are always changing, you know.
Right.
They're not static.
So what are like the main things that actually determine interest rates? Like who or what
Good question.
is pulling the strings here?
So one of the biggest players is central banks,
Okay.
like the Federal Reserve in the U.S.
Mm-hmm.
They're like the conductors of the economy. They set key benchmark interest rates
Uh-huh.
that kind of ripple through the entire financial system.
So if like the Federal Reserve decides to raise interest rates, does that mean that like everyone has to pay more for their loans or?
Not directly, but it definitely influences
Okay.
the rates that banks offer
Gotcha.
on loans and savings accounts. So
Yeah.
central banks use these adjustments to try and keep the economy in harmony, you know,
Right.
like adjusting the tempo to keep the music flowing smoothly.
I like that analogy.
Yeah.
Keep it in harmony.
Yeah. So for instance, if inflation is running hot,
Uh-huh.
they might raise rates to try and cool things down, you know,
Right.
and prevent prices from spiraling out of control.
Right. Yeah, that makes sense.
Yeah.
But isn't there like a risk that raising rates too quickly could like backfire and hurt the economy?
Yeah, that's a constant debate.
Okay.
Among economists, it's a delicate balancing act for sure.
Right. Yeah.
And in addition to inflation, things like economic growth
Uh-huh.
and the supply and demand for money, those also
Okay.
can push interest rates
Right.
up or down. So it's like
Yeah.
it's a complex ecosystem
Got it.
with all these elements kind of interacting and influencing each other.
So it's not just some like random number.
No.
It's a reflection of like the overall health of the economy.
Exactly.
Okay, that's starting to like paint a clearer picture for me.
Good.
But how do these interest rate changes actually affect like me?
Yeah.
The average person
Right.
just trying to like manage their money.
Right. That's where it gets really personal.
Okay.
Because interest rates have a direct impact on how much you pay for loans, like mortgages,
Right.
for buying a house.
Yeah.
Or auto loans for a new car.
Right. So if interest rates go up, my like monthly payments on those loans would also increase.
Exactly. Yeah. So rising interest rates can make borrowing more expensive.
That doesn't sound fun.
Yeah, it can be a challenge. Let's
Somebody else go.
dive into mortgages, for example,
Okay.
since they're often one of the biggest loans people take on.
Yeah, for sure.
Even a seemingly small change in interest rates
Okay.
can add up to thousands of dollars in extra interest payments
Oh, wow.
over the life of your loan.
That's a scary thought.
Yeah, it's significant. That's why it's so crucial for borrowers to understand
Right.
how interest rate fluctuations can impact their affordability.
Absolutely. Okay, so we're talking mortgages and how much interest rates can impact them.
Yeah, it's pretty wild how much a small change in those rates can add up.
Like, how much are we really talking here? Like, if I'm looking to buy a house.
So imagine you're buying a house, say $300,000 mortgage.
Okay, $300,000.
Right now, the interest rate is like 4%.
Okay.
Your monthly payment would be around $4,432 just for principal and interest.
Okay, that makes sense.
But let's say interest rates climb and you end up with a 5% rate
Oh, no.
on that same loan.
Yeah.
Suddenly, your monthly payment jumps to like $16,610.
Wow, that's like almost $200 more every month.
Exactly.
That's a huge difference.
Huge. And over the 30-year term of a typical mortgage,
Oh, my God.
that 1% difference
Yeah.
can mean paying like over $65,000 more
What?
in interest alone.
Seriously?
Yeah, it's crazy.
That's insane.
That's why it's so important to understand
Yeah.
how interest rate changes
Wow.
can impact affordability.
Okay, so what can borrowers do to like protect themselves or try to mitigate some of that risk from rising interest rates when they're looking at a mortgage?
Right. So one option is to consider a fixed rate mortgage.
Okay.
So your interest rate stays the same
Right.
for the entire life of the loan.
Gotcha.
No matter what happens with interest rates in the broader market,
Yeah.
that gives you stability,
You're at peace of mind.
Exactly.
Yeah.
Knowing your monthly payments won't just suddenly spike up.
Okay. That sounds like a good option, especially if like the market is really volatile.
Exactly.
Yeah.
It gives you peace of mind.
Are there any downsides to fixed rate mortgages?
Well, one potential downside is that fixed rate mortgages might have a slightly higher initial interest rate
Oh, okay.
compared to adjustable rate mortgages.
Oh, right. RMs.
Yeah, exactly.
The ones where the interest rate can change over time.
Right. So RMs
Okay.
can start with a lower interest rate,
Which sounds tempting.
which is tempting.
Yeah.
But the catch is that that rate can adjust periodically based on market conditions.
Right. So your payments could go up if interest rates go up,
Exactly.
but they could also go down if interest rates go down.
Exactly. It's a little bit of a gamble.
It is a gamble.
Yeah. So choosing between a fixed rate mortgage
Yeah.
and an adjustable rate mortgage really depends on your individual circumstances, your risk tolerance, and how long you plan to stay in the home.
That makes sense.
So if you think you might move in a few years,
Yeah.
an ARM might be a good option
Huh.
to take advantage of that lower initial rate.
Right.
But if you're settling in for the long haul,
Uh-huh.
the stability of a fixed rate might be more appealing.
Right. That makes sense.
Yeah.
This is making me think about like all the different things you have to consider when you're getting a mortgage. It's not just like picking a house and you're done.
It's a big decision.
That's a huge decision.
It's a big commitment.
That's a lot to think about.
And it's crucial to do your research and figure out what type of mortgage
Yeah.
aligns best with your financial goals.
Absolutely.
Yeah. And remember, it's always wise to shop around
Right.
and compare rates from different lenders.
Yeah.
Don't just settle for the first offer you get.
Yes. Shop around.
Yeah. A little research can save you a lot of money in the long
Have
run.
a lot of money. Yeah.
Absolutely.
Okay, so we talked about mortgages, but interest rates also affect other types of loans, right? Like what about auto loans?
Absolutely. Auto loans are another major loan that many people take on.
Yeah.
And just like with mortgages, higher interest rates mean you'll pay more in interest over the life of the loan.
Right. So if I'm thinking about buying a new car, it would be smart to try to get a loan when interest rates are lower.
In theory, yes.
Okay.
But you also need to consider that car prices themselves can fluctuate,
Right.
based on supply and demand and market trends.
Yeah, that's true.
It's finding that balance
It's like a balancing act.
between finding a good deal on the car itself
Right.
and securing a favorable interest rate on the loan.
Right. It seems like everything in finance is connected.
It's all connected.
Yeah, it is. What about student loans?
Oh, student loans.
Yeah. Those interest rates can be a real burden for people just starting out their careers.
Yeah, student loans are a unique situation.
Yeah.
And understanding how interest rates work is key to managing that debt.
For sure.
You have different types of student loans, federal and private,
Right.
and they come with their own set of terms and interest rates.
Ah. When I was applying for student loans, it was so overwhelming just like trying to understand all the different options and all the different interest rates.
That's a lot to navigate.
It is.
Yeah, so federal student loans often have fixed interest rates,
Okay.
which offers some stability.
Right.
But those rates can vary depending on the specific loan type and when you borrowed the money.
Gotcha.
Private student loans, on the other hand,
Mm-hmm.
can have either fixed or variable interest rates.
Okay.
And those rates are often influenced by your creditworthiness.
So having good credit could really pay off when it comes to student loans.
Absolutely. Building and maintaining good credit can help you qualify for loans and potentially get you a lower interest rate,
Right.
saving you money over the life of the loan.
Awesome.
Yeah, it all comes back to those healthy financial habits.
Speaking of good habits, let's switch gears and talk about how interest rates affect savers.
Okay, let's talk about saving.
We touched on this a little bit earlier, but
Yeah.
I want to go a little bit deeper.
Let's get into it.
So higher interest rates are generally good news for savers, right? Because your money earns more interest while it's just sitting in a savings account or a CD.
Exactly. Higher interest rates are like a bonus for savers.
So does that mean that I should constantly be looking for the highest interest rates on savings accounts?
It's good to be aware of the rates available.
Okay.
But remember, the highest rate isn't always the best option.
Right. Okay.
Sometimes factors like convenience, security, or the reputation of the financial institution might outweigh a slightly higher rate at a lesser-known bank.
Right. So it's about finding that balance between earning a good return, but also like feeling good about where your money is.
Exactly. It's about finding that sweet
Yeah.
spot where
Yeah.
you feel comfortable and confident.
Okay, cool. So what happens when interest rates are really low?
Ooh, that's a good question.
Like, is it even worth saving then?
That's a common question.
Yeah.
When interest rates are near zero, as we've seen in recent years,
Right.
the returns on traditional savings accounts can be pretty disappointing.
Yeah.
It can be tough to grow your savings at a pace that keeps up with inflation.
So what's a saver to do in that situation? Like, do they just accept the low returns or are there other options to consider?
You don't have to settle for low returns.
Okay.
While it's still crucial to have a solid emergency fund
Right.
and a readily accessible savings account,
Uh-huh.
you might also want to explore other savings and investment options
Okay.
that offer the potential for higher returns.
So it's about diversifying and finding that mix of savings and investments that aligns with your risk tolerance and your goals.
Exactly. It's all about finding that balance
Finding that sweet spot.
between risk and reward.
Right. And we're back. So we've spent this deep dive talking all about interest rates.
Yeah, we've gone from like the basics of how they work to how they can impact like borrowers and savers.
Yeah, for sure. It's been a really interesting journey.
It has.
I feel like I've learned a lot already.
Good.
So, as we wrap up, what are like the most important takeaways you'd give to our listeners as they continue on like their own financial journeys?
I think the biggest thing is to be proactive about your financial education.
Okay.
Don't let like financial jargon or complex concepts like scare you away.
Right.
There are tons of resources out there, books, podcasts, online courses
Totally.
that can help make the world of finance way less intimidating.
It's like learning a new language.
Exactly.
Once you understand like the basic terms,
Right.
you can start to make more informed decisions
And feel more confident.
and have more meaningful conversations.
Absolutely.
Yeah.
About your money.
Right. It takes time and effort,
Yeah, for sure.
but it's so worth it
I agree.
to feel empowered.
So it's a journey.
It is.
It's a lifelong journey of financial literacy.
Absolutely.
And another piece of advice that you mentioned earlier is to stay informed about interest rate trends.
Yeah.
How can our listeners stay on top of those changes?
Right. And figure out what they might mean for their own financial goals.
Yeah, keeping an eye on what central banks are doing is a good starting point.
Okay.
Pay attention to those economic forecasts and try to understand how those broader trends might affect you personally.
So it's like connecting the dots.
Exactly.
And seeing how the bigger economic picture translates to your own personal finances.
Exactly.
That's
It's
awesome.
like getting a sneak peek behind the curtain of how the financial system works.
I love that. And of course, interest rates are just one piece of the puzzle.
Yeah.
It's also important to have good financial habits in place,
Oh,
like budgeting, saving, and managing debt.
yeah, those foundational things are so important,
Absolutely.
laying that groundwork.
So combining a solid understanding of interest rates with all of those healthy habits can really set you up for success.
Absolutely. It empowers you to take control
Yeah.
and build a stronger financial future.
So true. Now, before we go, I'd love to hear your thoughts on this. Given everything we talked about today, do you think interest rates are more likely to go up or down in the coming year?
That's a tough one.
Yeah, and how do you think that might impact decisions about buying a house, investing in the stock market, or just other financial goals that people might have?
Right. Well, it's really anyone's guess,
Yeah,
but it's something to definitely think about.
for sure. Well, I think this has been a really eye-opening deep dive.
It has.
Thank you so much for breaking down all this stuff about interest rates.
Of course, my pleasure.
To all of our listeners out there, thanks for tuning in. We hope you learned something new and feel empowered to take control of your own financial journey.
Absolutely.
Until next time, keep exploring, keep learning, and keep diving deep.